Hi, this is Patrick Adams with This Week's Market in a Minute. Making money when the Fed pivots. Don't get sucked into the idea that when the Fed starts to cut rates that the market's going to go up, because there's a lot of negative news, probably some large systemic issues to occur to make the Fed cut rates. That's what always has happened. I'll walk you through all this and give us all a plan to how to make money when the market hits at a nice level and when it's probably hit at a bottom. We think that'll probably come later this year or into 2024. So as we look at the markets, it's above the 200-day moving average, which is positive. So we do have a positive signal there. However, it's a downward sloping 200-day moving average, which really means that there's some upside, but it's going to fade. As we look at the fundamentals of the market, there's no earnings momentum, and we are going to get earnings reports here soon. They will probably be decent, but earnings are not going to go up. The valuations of the market are expensive now, and we think that 2025 earnings will look more like what 2024 earnings expectations are. So the earnings estimates are going to come down. However, when you look out to 2025, we'll likely have $250 in earnings, and we might be able to get as much as a 20 multiple on those earnings, getting us to a price target of roughly 5,000 for the S&P, up 25%. But first, there's some nasty stuff to come. The Federal Reserve, we think they're likely done raising rates, but it depends on what the employment report looks like when it's reported this Friday. If the employment report is less than 200,000 jobs, we think they're done. If it's above 300,000 jobs, there could be one final rate increase. So with the expectation that the Fed was likely done raising rates because of what's happening in the banking sector, we thought there would be a knee-jerk reaction to that and the markets would move up, and it's done that. So we think for sure on May 3rd we will know the direction of interest rates. As I said, likely will stop in some manner at that point. Now, if you look at the reason why the market's going to fall when the Fed pivots, it's real simple. They're going to break something. They always break something. We will likely be in a recession. The yield curve is inverted, which has always given a negative signal to the economy that it is going into a recession. Always. When the yield curve inverts, we go into a recession. So what will happen during this recession? Well, there's probably going to be a credit cycle. The more leveraged loans will have to go up significantly in the rates that they're paying, and commercial real estate will probably feel the big brunt of the rate increases that we've seen. It'll be difficult for these companies, these real estate projects, to get refinanced at a level that is commensurate with the returns they expected, and so you're probably going to see some defaults. Now, it's real important to think about getting defensive when the market begins to roll over. There is a significant amount of money that could be lost during this period of time, and it's always happened. I'm going to walk you through it. So this is roughly 50 years of data, 60 years of data, excuse me, and we will focus on the last couple of major bear markets. But you can see here, when the Fed pivots, you go back all the way to the 1960s, the market declines because they're pivoting for a reason. Pivoting means cutting rates significantly for a period of time. So pivot, another decline in the markets, pivot, another decline in the markets in the mid-70s. Obviously, when the Fed finally was done in the early 80s, the market finally took off, but it declined as they were cutting rates. Now, if you look at probably the period that most people remember, maybe remember well, you can see back in 2000, okay, the Fed kept rates flat for a short period of time, had the pivot. the economy was falling apart, we're in recession, they brought rates down in a major way and set a bottom 50% lower. Okay, we had a nice rally into 2007, hit a high there, so it took roughly 7 years to get back to even. So this is what I'm talking about. You don't want to lose money during these periods. You want to be defensive. We're approaching that point. So keep that top of mind. So 7 years to get back to even after the 2000 decline. Okay, so in 2007, when we got back to even, we had another 50+% decline in the markets. The Fed took rates all the way down to essentially zero, and the markets had a very nice run through here. But when the Fed pivoted, the markets didn't go up. You see that? The markets went down. The markets fell because there was something wrong with the economy, in the financial system. So that's what we have to look forward to, unfortunately. The way to play this is to let it fall, right, and enjoy the big upward movement that we will see likely occurring as the market looks out to 2025. So this is a massive increase that we saw from the bottom of the market in 2009 to basically 2000, massive increase. Now, why are we so fixed on protecting the downside? Because it's real simple. You lose 50%, you got to make 100 to get back to even. 100% to get back to even. It takes years to do that. So this is a little mini version of this, right? The NASDAQ fell 33% last year. It's up almost 17% in the first quarter, which is great. And if you would have caught that, that would have been awesome. But there's another decline coming. The result of being up 16% is that you're still down 22%, but you need to make 28% to get back to even. That's not going to happen this year, and it likely won't happen next year. It'll probably be a 2025 event. That's why protection of capital is so important. You can really maximize your returns if you get defensive properly at the right time. We're not there yet, but it's coming. So remember, when the Fed pivots, just chill out. There's no bull market yet. It has a ways to go because they're pivoting for a really good reason. Now, this might be the reason. If you look at bank deposits, the bank deposits are down roughly $500 billion in the first quarter. It is an incredible amount of money. $500 billion left the banking system. What the banks do is they leverage up that $500 billion of deposits, and they can make roughly $5 trillion of loans, right? 10x. They can leverage those deposits 10x. So that's a lot of credit that won't be in the system. So it'll be more difficult to get a loan. Again, what's likely at issue is the higher yielding loans. We're seeing the classical crowding out effect. So the marginal loans won't get funded. Some of that's in real estate. There's a big real estate portfolio on a lot of the regional banks. Why is this the reason? Where did the money go? Well, the Fed pushed interest rates up so much on the short end, you could get close to a 5% yield or more on a short-term treasury note. Why keep your money in the bank? This makes no sense. Why keep the money in cash at your broker-dealer? You can put that money into the treasuries and make a decent return. So that's the reason why money left the banking system. It's finding safer grounds. With the higher rates, it's the classical crowding out effect. It's because of government borrowing, too much borrowing by the government. The Fed has to be restrictive to cut interest rates. So just keep in mind, to make really good returns, you're going to have to be defensive here sometime this year. I would strongly advise you not to listen to your broker that says keep that particular position of whatever growth manager it is because it's great for the long term. Well, it might be great for the long term, but it's probably not great for the next several years. And you're going to have to be very patient with that position to make the money back up. So thank you very much for watching this. If you want more information about the strategies that I manage, go to my website, Patrick Adams CFA, or go there and sign up for our Market in a Minute research piece that we put out every week, a hard copy of these thoughts, and we will email that to you. Again, thank you for your time. Hit like, hit subscribe, and we'll talk to you next week.